Every financial empire rises on pillars most people never see. And sometimes the first cracks appear not with an explosion, but with a quiet shift, one policy change, one currency movement, one unexpected announcement from a central bank thousands of miles away. For decades, the United States believed its economic foundation was unshakable. But today, one of America's most trusted partners is making a move that could reshape global markets. This is the story of how Japan, America's silent financial backbone, may now become the trigger for the next global reset. For more than half a century, Japan has been the United States' most dependable financial lifeline. While China steals the headlines, it's Japan that quietly sits on over $1.18 trillion in U.S. Treasuries, making them the single largest foreign holder of American government debt. More than China, more than the UK, more than anyone. But what makes Japan truly pivotal to the dollar system isn't just the size of its treasury stash. For decades, Japanese investors have been able to borrow yen at almost zero cost and funnel that ultra-cheap money into U.S. markets, stocks, bonds, real estate, anything with a pulse. This strategy, known as the yen carry trade, is conservatively estimated in the hundreds of billions, with total yen-funded exposure likely stretching into the low trillions. Pause and think about that. Trillions of dollars in liquidity holding up American asset prices, all financed with a currency that's been basically free for 20 years. This wasn't just foreign investment, it was one of the hidden engines powering U.S. prosperity. It held interest rates down. It inflated equity valuations. It made America's huge deficits seem painless. Japan wasn't merely buying our IOUs, they were underwriting the entire American growth story. That era is over. On December 1, 2025, Bank of Japan Governor Kazuo stood before business leaders in Nagoya and delivered a statement that detonated across global markets. He revealed that the BOJ would debate the pros and cons of lifting its policy rate at the meeting scheduled for December 18-19. Within hours, markets convulsed. Rate hike odds jumped from 58% to 76% overnight. Yields on Japanese government bonds surged to levels not seen since 2008. The yen roared higher. Investors worldwide began to panic. Why? Because after almost a decade of negative rates, Japan is finally tightening its monetary stance. And when Japan tightens, the shockwaves hit every corner of the global financial machine. Current intelligence indicates the BOJ is preparing to raise rates from 0.5% to 0.75% this month. And that's only the first step. Bank of America now expects the terminal rate to climb to 1.5% by late 2027, with additional rate hikes penciled in for June 2026, January 2027, and July 2027. These numbers might look tiny on paper, but in a country that's lived with zero or negative rates for over 2 decades, even small moves can unleash monumental tremors. And here's where things get dangerous. The yen carry trade, that so-called free money strategy, is now unwinding. Rising Japanese rates and a stronger yen mean the entire trade suddenly works in reverse. And it's not a gentle reversal, it's a violent snap. When the carry trade collapses, investors are forced to dump U.S. stocks, U.S. bonds, and other dollar-linked assets. They then convert those dollars back into yen to repay their loans. That selling pressure hits everything from the dollar to American equities to long-term treasuries. We've already had a preview. In August 2024, when the BOJ delivered a surprise rate hike, the Nasdaq 100 cratered 13% in under a month. The yen soared 14% against the dollar. Global markets spiraled. And that was from one tiny rate increase. Now imagine several hikes spread across the next 2 years. The potential damage is staggering. But the story gets even darker. While the carry trade is unwinding, Japan is also dumping U.S. treasuries. In Q3 of 2024, Japanese investors unloaded a record $61.9 billion, the largest quarterly sell-off Japan has ever recorded. And the selling didn't stop. Between January and April 2025, they offloaded roughly $227 billion more, much of it long-dated bonds, according to J.P. Morgan. Treasury officials will tell you this is no big deal. They'll say the market is deep enough to absorb it. But that's only half the story. The real danger isn't the raw numbers, it's the shift in psychology. When your biggest creditor starts heading for the exit, everyone else begins to rethink their exposure. They demand higher yields. They reassess risk. That's exactly what happened after Trump unveiled his aggressive tariff plans in April 2025. 10-year Treasury yields spiked to 4.92%, the sharpest weekly jump since 2001. The panic spilled straight into equities, dragging the S&P 500 down 12% in just 4 trading days. Analysts say most of the selling pressure came from, you guessed it, Japan. So why would Japan destabilize its closest ally? Because they no longer have a choice. Japan has been cornered for years. Their economy stagnated. Their population shrank. They deployed every tool: negative rates, unlimited QE, direct market manipulation, and none of it produced lasting growth. Meanwhile, the yen collapsed. In 2024, it sank to 161 per dollar, its weakest level since 1986. That crushed Japanese purchasing power, made imports painfully expensive, and triggered inflation levels the country hadn't seen in decades. Retirees saw their savings erode. Households struggled. Public anger boiled over. The government was forced to act. And here's the tragic twist. Japan's support of the US financial system is what kept the yen suppressed in the first place. As long as they bought treasuries and kept rates pinned to zero, their currency stayed weak, and their citizens paid the price. So now Japan faces two impossible choices: keep sacrificing their own economy to support the dollar, or pull back and risk shaking the global system. They've chosen their own survival. And that leaves America exposed. But the yen carry trade and the Treasury liquidation are only the beginning. Three enormous forces are now converging, each one capable of shaking the dollar on its own, but together forming a perfect storm. First, Japan's rate hikes are ripping apart trillions of yen-funded positions that have been woven through global markets for decades. Second, Japan is no longer the reliable buyer of US Treasuries it once was. In fact, they're stepping back, even selling, at the very moment America's deficits are ballooning toward $2 trillion a year. And third, the threat almost no one in mainstream finance wants to acknowledge: the global de-dollarization movement has gained real momentum. BRICS countries are trading more in their own currencies. They're building parallel payment networks like BRICS Pay to avoid SWIFT. And they're buying gold at a historic pace. In 2024, central banks added 1,045 metric tons of gold, the third straight year above the 1,000-ton mark. China and Russia now settle over 90% of their bilateral trade in yuan and rubles. India is striking local currency trade deals with the UAE, Indonesia, and others. And even Saudi Arabia, despite the misinformation floating around, is openly entertaining the idea of pricing oil in multiple currencies: yuan, euros, even yen. The dollar's share of global reserves has slid from 85% in the 1970s to 58% today, and the decline is speeding up. Dollar skeptics will tell you there's no BRICS supercurrency coming soon, and they're right. India doesn't want it. Internal fractures among BRICS members are real. But here's what they miss: you don't need a single replacement currency to weaken the dollar. All you need is enough global momentum moving away from it, and we're nearing that tipping point. Which leads us to America's nightmare scenario, one that is unfolding in real time. The Federal Reserve is trapped. If the Fed cuts interest rates too quickly to support the economy, the dollar weakens, foreign investors start selling U.S. assets, and the downward spiral feeds on itself, exactly what we saw in August 2024. But if the Fed keeps rates high to defend the dollar, they risk crushing the domestic economy. Higher rates mean pricier mortgages, car loans, and business borrowing. They strain banks. They make America's debt burden even heavier. And remember, this is happening as Washington runs $2 trillion deficits. The US needs foreign buyers to fund those deficits. But instead of buying, Japan and others are exiting. Wellington management analysts warn that this foreign ownership constraint means the Fed cannot cut rates as aggressively as markets are expecting, even if the US economy slows. They're stuck. Damned if they ease, damned if they don't. Which brings us back to December 19, 2025, now just days away. If the Bank of Japan raises rates as anticipated, the shockwaves will be immediate. 1. The rate gap between US and Japanese bonds will shrink even more, making the yen carry trade less appealing and speeding up its collapse. 2. The yen will likely strengthen sharply, forcing more investors to unwind dollar positions as hedging costs rise. 3. Japanese government bond yields will continue climbing, putting upward pressure on US Treasury yields, potentially sparking another wave of selling. 4. Capital will begin flowing back into Japan as domestic yields turn attractive for the first time in a generation. Japanese banks, insurers, and pension funds control trillions in foreign assets. Even a mild repatriation could slam global markets. And that's just the short-term effect. The long-term implications are far more profound. As one risk analyst recently put it, the Bretton Woods 3 scenario, a global financial system built around commodity-anchored currencies and reduced dollar dominance, is no longer theoretical. It's becoming a credible path. Think about the three pillars that propped up the dollar for half a century. Pillar 1. The petrodollar system, oil priced in dollars and oil exporters recycling their profits into U.S. assets. This pillar is eroding as major producers diversify. Pillar 2. Allies like Japan financing U.S. deficits by holding massive treasury reserves. This pillar is fracturing as Japan chooses domestic economic survival. Pillar 3. Carry trade capital and other foreign inflows chasing U.S. yields. That pillar is collapsing right now. When all three weaken at the same time, which is exactly what is happening, the entire structure starts to wobble. So what does this mean for you? In the near term, brace for extreme volatility. The BOJ's December 19th decision could set off violent market reactions, sharp drops in stocks, turbulence in the bond market, and aggressive swings in currency exchanges. But the deeper danger isn't the next few weeks. It's the next few years. As Japan keeps normalizing monetary policy and the carry trade continues to unwind, the U.S. will face steady downward pressure on asset prices and rising borrowing costs. Funding America's deficits will get harder. Maintaining today's standard of living will become more challenging. And for the first time in decades, the structural flaws in the American economic model, flaws masked by endless foreign capital, will be exposed. And here's the thought that keeps analysts awake at night. Once this process begins, stopping it is incredibly difficult. Capital flows behave like water. When the dam cracks, the flood follows. Right now, those cracks are spreading in plain sight. The American financial order was built on three foundations: the petrodollar, foreign treasury demand, and yen carry liquidity. Piece by piece, those supports are disappearing. And once the last one goes, the entire system will need to be rebuilt. This is why you won't hear this on mainstream financial TV. This is why commentators keep insisting everything is fine. Because if the public understood what's actually happening, that the pillars of American prosperity are eroding, panic would come fast. And panic is the one thing the system can't afford. But this isn't about fear. It's about clarity. The dollar won't collapse tomorrow. American power won't vanish overnight. But the world is shifting, and assumptions that held true for 50 years no longer apply. Japan has just fired the opening shot in what could become the greatest challenge to dollar dominance in modern history. And on December 19th, we'll learn whether this is merely a warning, or the true beginning of the end. The dollar's greatest test has arrived. And this time, there's no rescue coming from Tokyo. Stay alert. Stay educated. And whatever you do, don't accept the comforting lie that everything is under control, because if it were, Japan wouldn't be preparing to pull the trigger. The countdown has begun.